Electronic trading firms are renowned on Wall Street for having, by and large, the most advanced, cutting-edge technology around. They're also known for having quite unique and meticulous cultures to cultivate their success. Citadel Securities, one of the largest electronic market makers, has one such unusual quirk: a £50 physical book with hundreds of pages, seen in full by only a handful of people. How does it work? We'll find out on the Coffee Run. Every day on eFinancialCareers.com, we give you a rundown of news in banking, finance, and beyond on Morning Coffee. On the Coffee Run, we break down the biggest story of the week and let you know other important stories you might have missed. This week's top story, as reported by Bloomberg, is about Citadel Securities' Goal Book. It's a yearly document produced by the firm with over 5,000 goals written by each of its roughly 1,800 employees. Before we dive into what this goal book is, it helps to know what Citadel Securities does. It's known as an electronic market maker. What this means is that it trades a massive amount of an electronic security like equities or crypto on a daily basis. It constantly buys and sells these securities, providing liquidity and stability to a market. Rather than betting on whether the price of an asset will fall or rise, it makes its money by quoting buyers and sellers slightly different prices and pocketing the difference. It does this on a monumental scale. Citadel Securities is a big player in the US equities market, accounting for more than a third of trading volume for US stocks and shares. The firm made $9.7 billion last year doing so. Back to the goal book. Citadel Securities starts work on its book of goals in January so that it knows exactly what it's up to during the year. It can be intense, with each manager proposing hundreds of initiatives. Every one of them is then reviewed by Citadel Securities CEO Peng Zhao, and the best proposals are then streamlined. Initial proposals have timelines and measurable outcomes, but the final proposals are expected to be distilled into roughly 150 words with a few bullet points. Once the book is complete, tasks are assigned and the work begins. The goal book is great for setting goals, obviously, but not so great if you like a freestyle and fluid working environment. Citadel Securities employees said anonymously that the biggest initiatives are top-down and that the obsession to deliver on these improvements creates an intense environment where people fear for their job security. The firm's chief people officer, Alex DeLeonardo, told Bloomberg the firm has a social contract with people who join it and that they receive exponential career growth for their efforts. Citadel Securities also offers very generous pay. Citadel Securities paid its staff roughly $1 million per head for the first half of 2025, implying that it's on track to pay $2 million on average this year. Citadel Securities pays similar to Jane Street, another electronic trading firm and arguably Citadel Securities' biggest rival. Employees have told us that the two firms are incredibly different, however. For one, Citadel Securities imposes non-competes on its employees, meaning they can't work for a competitor for months or sometimes years after they leave. Jane Street lets its staff leave whenever they like. Perhaps because of Citadel Securities' extensive goal setting, staff there have a much better idea of how they impact the organisation. At Jane Street, meanwhile, insiders tell us that traders sometimes don't even know how much profit or loss they're making. This plays a role in career progression. Some Jane Street staff say it's difficult to get promoted, even as a high performer. At Citadel Securities, you know where you stand. Citadel Securities also has a brusque culture, according to Akshay Chalana, a former engineer turned AI startup founder. He said working there is emotionally intense and that people won't soften their disappointment. Jane Street and Citadel Securities have a shared passion, however: graduate recruiting. The two firms scour the world's top universities for the most elite technologists and mathematicians, bringing them in as graduates and interns. Interns at either firm are known to have been paid $20,000 per month while working there. Jane Street's applicant acceptance rate is unknown, but less than 1% of people who apply to internships at Citadel Securities actually get in. Jane Street so far this year has massively outperformed its electronic trading rivals. It made total revenues of over $18 billion in the first half of this year, while Citadel Securities and Hudson River Trading, another major trading firm, each made between $5 and $6 billion. Closing ground on Jane Street may well be a key focus of next year's goal book. That's not the only big story in finance this week. The Wall Street Journal reports that the hiring market for very senior bankers is red hot right now. While that's good for senior bankers, it's not clear whether or not that's actually good for everyone below them. The hiring boom will be good for more junior bankers if it's caused by increased deal flow, in which case banks will need more people at all levels to work on those deals. This might be the case. Goldman Sachs, for example, has predicted that next year will be the largest ever year for mergers and acquisitions. There's another potential cause though. Viz Raghavan joined Citi from JP Morgan to run its investment bank just over a year ago and has been steadily hiring a lot of his prominent former colleagues. JP Morgan has had to replace those people while making other hires. It brought in up to 100 senior bankers in the past year. The banks these new arrivals joined from then had their own vacancies that needed to be filled. Rather than there being a genuine increased demand for hiring, it might just be a carousel effect. And even if the money is caused by increased deals, it might simply mean that banks spend all their money hiring senior bankers who won't generate fees for a while, at least until deals are completed. From Bloomberg, meanwhile, an ex-Goldman Sachs trader is suing Toronto-Dominion Bank over the enforcement of a one-year non-compete. The lawsuit gave details into his experience at the bank, which was fraught with problems. Matthew Austin is a quant trader. He was hired by TD into a voice trading, a non-electronic trading team. In the time it took for him to launch his trading strategy, TD had fired half of its sales and trading team, including the head trader he was supposed to be working with. The remaining half of the team refused to execute the strategy, and the new head trader said the team hadn't bought in. After he complained, he claims that his manager told him that he was neither unique nor exceptional, so he resigned. It doesn't sound like the ideal job move. Austin was a VP at Goldman and a director at TD, implying he was promoted as part of the role. However, Austin claims the head trader at TD didn't want to run his strategy as he knew where the market was heading. And the top story from us at eFinancialCareers was that we spoke to a chief compliance officer in a financial services firm about the trials and tribulations of working in compliance. He described a compliance career as a trap with high risk, low reward, and minimal exit opportunities. You have a high degree of accountability, which means a heavy workload, but because you're not a revenue generator, compensation is naturally capped. The chief told us that people looking for new jobs in compliance are only doing so because their skills aren't transferable and they need to pay the bills. He told us that his long-term goal is to hand in his resignation letter and that he's investing his money in his spare time to earn enough to make that possible. Thank you for watching The Coffee Run. If you want to check out our articles, you can go to eFinancialCareers.com or you can subscribe to our newsletter by following the link below. You can also like this video and subscribe to the channel if you want to get more news updates like this every Friday.